Robert gets the first question because you're referencing something I said yesterday. So you were watching and you thought that was compelling question. Did I ask about the secular bull market?
Yeah, you did mention that. In fact, I think...
And you were watching.
I was watching.
That's why you get the first question. We may
Excellent.
get to you.
See how this works? I got ideas on this.
We may get to you. Anyway, is your answer yes? But,
yes, it is.
But be defensive for a little while longer?
Yes, we are in a bull
yes, we are.
Secular bull market.
Yeah.
Look, if you look at the 200-week moving average, it's a 4-year moving average. It's just a very good proxy for markets long term. You go back to the 50s and 60s, 80s and 90s, the market tends to skip off that long-term trend. That's what we saw in December last year. Almost to the point, the market came down to 2346. And then ricocheted off that level. That's what we saw in 2016. That's what we saw in 2011. So as a definition of what trend is, the market's still in a secular uptrend. Is that turning? I don't think it is, but that's a question for later on. But at this point, yes, we're definitely still in the secular bull market.
You think even cyclical parts of the market could be bottoming in this quarter?
I actually do.
Possible.
When you look at the financials and you look at the industrials, they're weak charts. They've been in sideways to down trading ranges for 18 months, 12 months, depending on the stock. But the long-term data is actually trying to bottom. And I know it's very contrarian, and the relative performance for these areas have been very weak. But I think we're coming into a zone where you got to be very careful being excessively bearish. The market itself, 28, 22 is a pretty critical level. The short-term data is getting deeply oversold here. I'm not wildly bullish, but I think in the next couple of days, we're at a very key inflection point. I think there's a high chance the market inflects to the upside.
Brian, in looking at your comments today, I didn't find much for you to like in this market right now. You think that trade issues have been sort of underestimated by market participants, and they're coming home to roost now. But interest rates are low. Is that a positive, or is it a reflection of slow growth?
I wouldn't characterize my view as being overly bearish. I mean,
what are you?
I'm actually optimistic. I think that what you've had is an environment where investors have gotten defensive, and you've seen rates go down amid policy uncertainty, and a lot of the leading indicators have declined amid that uncertainty of trade. I actually think that we could be heading into a period of better clarity on policy, and we've probably gotten too concerned about where we're heading on this. I think the administration, I don't think you need to get to this great trade deal. I think you need to see some improvements in sentiment, improvements in tone that helps to improve business sentiment. And these leading indicators will start to pick up. The yield,
yeah. Go ahead. But for both of you who, to the extent you're not bullish but neutral,
I wouldn't characterize it as neutral.
Or whatever it is this like a last gasp for air kind of thing? Meaning, or do you think that there's like a lot of room to roll?
To roll over?
No, in a good way. Meaning like this is going on in a positive, in a bullish way, that somehow this is going on for a lot longer. Or is this like what happens at the tail end? And everyone's going to get their last, bit of oxygen. You'll get a little bit nice jump, but then we're going to.
So Andrew, I've been saying this is going to be the longest cycle on record. We got there. Now I'm telling people this is going to go on for far longer than most people suspect, because we really haven't gotten started yet. I mean, valuation stocks are still cheap to bonds. Credit growth hasn't been excessive. Cumulative growth in the economy has not been huge. There's no inflation. The Fed is backed off their tightening stance. All of that is conducive for risk assets to go higher and the cycle to continue. This is the third time in this cycle that we have had a marked slowdown amid policy concern. First one was the European debt crisis. The second one was the Fed in 2015 into 16, and this is the third one.
This still doesn't feel like a huge pullback to me. I mean, it's 2 days where you're down, but you're still talking about the S&P just below 2,900.
Yeah, but we've been sort of rolling through it. So,
right, if you look back to where we were a year ago.
Right, we had the correction in 18 amid the Fed rate hikes. We had some downturn in May with the escalating Mexican tariffs. Now we're dealing with, again, with ongoing trade uncertainties. So these are declines as the market tries to digest policy uncertainty. This is not the end of the cycle. This is a pause amid trade uncertainty.
I don't know when we talked to you. So you had a good night's sleep, and it's Thursday or something, because if I read your notes here, you were in such a bad mood yesterday.
No.
The uncertainty surrounding the trade conflict has weighed on business sentiment significantly. As a result, the global economy has slowed meaningfully.
Yeah.
U.S. leading indicators are pointing towards further slowing. The bond market is viewing this as a policy mistake. The risk is that further uncertainty further deteriorates economic activity and leads to a recession. The models are showing slowing growth, but not yet in recession territory, but we could get there if policy uncertainty persists. I've read the entire page of your notes. I haven't seen one positive.
No, Joe. I was responding to questions that were being asked.
Were we guiding you? Were we talking you into negative comments, Brian?
So the questions
we would never, far be it from the media to do that.
No, the questions that were being asked to me is, why is the market so upset?
Right.
Why does everything look so bad? Why is the yield curve look like it's
Don't tell me this.
So I was responding to those questions.
Don't tell me this. I apologize then, because I thought they were.
Maybe that's on me where I need to push back and say,
yes,
I'm not going to directly
do
answer.
that.
So I was answering the question.
You don't have to be a hostile witness. It's okay. You don't have to be a hostile witness.
I just wanted to clear that up because I didn't want people to think I was accusing you of being negative when you weren't. Because when I read this, it's like, wow, Brian's in a, it's not bullish.
No, I mean, I think that, this cycle should go on long. It doesn't have to be this way. 2% growth, 2% inflation, the Fed easing, all that should be really good for risk assets. Sentiment's eroding because of uncertainty around trade. The administration can change that in an election year, and I expect they will.